There are three types of ions: positively charged ion, cation, a negatively charged ion, anion, and a humongously expensive charged ion, anions.
6-member committee, 3 from the RBI, 3 external.
From this multiple indicator approach, it was decided that monetary policy take on fix on one nominal anchor, as they call it, one quantity. And the best nominal anchor at that point was inflation. The stance serves a deeper purpose. It's a form of forward guidance where again you begin to indicate what is likely to happen over the next 2, 3, 4 policies.
If the money is less, then there are more people who want to borrow. In the latter case, the rates will go up. In the former case, the rate will go down.
Yeah.
What the central bank will do is, it will ensure there is enough liquidity.
Farm produce typically works on what is called the COP, meaning you produce more in a year, prices crash. In the next year, there is no incentive to produce. There's a supply shortfall, then prices rise. This increases volatility, and very unfortunately, vegetable prices seems to have become more volatile. This is the cause for concern.
Hi, and welcome to a very, very special episode of Open Dialogue. Joining me today for the conversation is Saugata Bhattacharya. Saugata is a member of the Monetary Policy Committee. Prior to this, he was the Chief Economist at Axis Bank. He has over 30 years of experience in economics, policy making, and related fields. Saugata was also part of the RBI's working group on operating procedures for the Monetary Policy Committee and the Ministry of Finance's subgroup on foreign savings. We are set for a very interesting conversation today on the Indian economy, the Monetary Policy Committee, how rates are set, and other very interesting topics. But before we dive into the episode, please do subscribe to the channel and click on the bell icon for notifications. Saugata, welcome to the show.
Thank you so much, Shavi, for having me on your show. I mean, this is a huge privilege for me, and being part of the Axis fraternity is so much more a pleasure for me to be here on your show.
The pleasure and privilege is all ours, Saugata. So, just getting into our conversation. So, let's start, Saugata. So this conversation I thought we'll do in 3-4 parts. One is, will be helpful to get your perspective on the economic environment, both India, global, etc. From a short-term perspective, given we are living in very interesting times. Also, I think it'll be interesting to understand just the MPC, how it works, what happens, and so on and so forth. And maybe we can spend a little bit time on the longer-term perspective and, where monetary policy steps in, but also where other things will also kind of come into being.
Sure.
So to start with, will be helpful to just get your perspective on where is the Indian economy today.
So obviously, it's very difficult to answer. I mean, there are various shades underlying this. So in the short term, the sense that I get reading the various high frequency indicators, the other surveys from RBI, surveys from other organizations, institutions, etc., there seems to be still a fair bit of resilience in economic activity. However, there is no denying the fact that given the uncertainty underlying the global economic environment, particularly the trade environment, and the spills over also into investment decisions. So there are definitely a significant number of challenges that can come in, and particularly now, because it's not just India relative to our emerging market peers, our competitors in the global export market. So with the differential tariffs that many of our the emerging markets are experiencing. So it's difficult to say how things will evolve. What we try to do is to, for instance, we don't even know how long the extra 25% penal tariffs will last. The base 25% tariff, whether that can be cut back with a emerging FTA, BTA with the United States. So all of this, so at best what we can do is lay out different scenarios, right? So what if the 50% tariffs are actually persist throughout the rest of the year? What if it's brought down to 19%, etc., and figure out what the likely outcomes are, assign probabilities, and move from there into whatever. So India's basic structural strengths still exist, but as you're reading in newspapers, in the media, in various discussions, etc., I think this is the time and the opportunity. This is what you said. I mean, uncertain times, the Chinese hieroglyph, that in danger lies opportunity. So exactly that. I think at this point in time, second, third generation reforms, which had fallen behind for some time, I think these now need to be accelerated for India's. This is the 1991 movement. I think a similar crisis is now, if not as much, very largely, partially so, it's upon us. And so this is the time now to be pushing forward on reforms, making India more competitive, irrespective of whatever happens in the rest of the world.
Right. So, Shobhatu, what you're saying is that there are certain structural strengths that India has, which is a large demography, young population, just the how various authorities, the RBI, government, etc., have managed the overall balance sheet of the country.
Absolutely.
It's in a very, very good shape. If you look at corporates, they are perhaps the least leveraged that they ever have been.
Right.
If you look at banking balance sheets, they are the healthiest that they've ever been. So from various perspectives, India seems to be actually, if you were to cut out all the noise and just look at a long-term, health of the country, it seems to be in a great place.
That's right.
And that structural strengths will continue.
That's right.
Having said that, there are short-term uncertainties, as you put it, which have come up. One obviously is the global kind of macroeconomic situation.
Yeah.
There are obviously kind of India-specific things as well.
Absolutely.
And hence we are perhaps at a time where, in order to fully benefit from our long-term structural strengths, there are some reforms that we need to make.
That's right.
And it's a great opportunity for us to do that.
Absolutely.
Great. Very helpful.
So this is again, I mean, the government from the fiscal side has already started the process.
Right.
So the tax cuts on corporates that were instituted in 2019.
Yes.
So that seems not to have produced the desired effects. But I'm sure that the direct tax cuts on individuals, and now the proposed GST rate rationalizations, the transformations of GST products, etc., that I'm sure will have a much deeper impact on household, consumer, enterprise demand in the system. So this is likely to be far more successful. So essentially what all of this is doing is transfer resources from the government onto individual enterprise and households. Now, who does a better job in increasing their consumption, demand, productivity, etc., remains to be seen. But I believe this is something that should have been done before. We have been talking about GST reforms, rationalization for a long time. Finally, we are at the stage where we are actually in the process.
Right. So one reform in your mind is taxation reform.
Yeah.
One part of which the corporate tax was done in 2019.
Yes.
In the last budget, there was this individual income tax cut.
Absolutely.
And now we are talking about rationalization of the GST, which in your mind, it will move kind of the money in hands of households becomes higher.
Right.
Because, we are not paying finally the GST is paid by consumers, and this is just pass it on.
Absolutely.
So that will remain in the hands of the households and more consuming power, and hence, hopefully
higher disposable incomes, more consuming power. So this is essentially the transfers between, I mean, the same thing happens between when you move interest rates up or down, there is a transfer of resources between borrowers and depositors, say for instance. It's the same thing. So who has a higher propensity to consume? So who will spend more on consumption of that marginal extra rupee that gets into their hand? So these transfers of resources is a very powerful lever.
Right.
And that's mostly a fiscal policy decision.
Right. So again, I think it's a very interesting way you framed it. Basically, taxation, if the taxes are high, the resources are moving from individuals and companies to the government.
That's right.
If the taxes are low, then the resources are moving to the individuals and to the companies, to the corporates.
Absolutely.
And so an implicit assumption here is that households will do a better job of consumption and using the resources.
Their own personal preferences on consumption, etc., might be a better indicator of underlying demand. And this is the classic Laffer curve that you would have heard about. Your viewers would probably have heard about. That there is a point in taxation where if you reduce taxes, your tax collections actually go up.
Right.
So, I mean, I don't think this is happening, because if you've seen the gross and net direct tax collections, it's actually gross is very low, net post after refunds is actually negative. So this shows that the government is actually giving back to the households. It's not so much that tax collections are coming down, but just the gross tax collection, because remember this started in April. And so the tax, the TDS, advanced taxes, etc., that was supposed to have been paid, lower taxes are being paid on that. So the transfer shift, the process of the transfer has already initiated, has already begun.
Right.
So now we wait to see what the actual odds are. And to a certain extent, you will see that FMCG companies are now beginning to say, I just saw a report yesterday that FMCG sales in August have in August of 25 are significantly higher than in August 24.
Right.
So that the rural prospects were anyway good at the beginning because of the normal monsoons, the government transfers to the rural areas, etc., the hike in MSPs, so all of that. So rural demand was anyway better. But now it seems that this is slowly shifting over to the urban areas, urban demand, where demand has been in deficit. I mean, compared to what we would have expected in the urban areas, the actual demand from the urban areas, that now seems to be gradually improved.
Right. Understood. So reform number one, so there is this taxation. Are there other things, similar things that?
Yes. So obviously, till now, what we have seen are more the output reforms.
Right.
So, but the factor market reforms, there's a fancy way of saying land, labor, judicial reforms, etc. So all of that. So now we are beginning to see talk of and actually some actions beginning to happen. The tax one is very important. That's the primary factor of production. And together with that, now increasing efforts to digitize land records, say for instance, consolidate land holdings in the agricultural sector. So we are beginning to see, and now the labor codes, the 4 labor codes, where the vast majority of labor laws have been compressed into these 4 codes. Pretty much now, almost all states have implemented this. So now we wait to see what kind of things begin to fall in place. There is the IBC, the Insolvency and Bankruptcy Code. Now that is being tweaked to make exits easier. So one of the key problems, structural problems, that has bedeviled India's enterprise ecosystem is the so-called dwarfing of companies in the. So unlike, say, in Germany, the Mittelstand, where, those are also medium sector enterprises, small and medium enterprises, but the scale is huge there, even of these small companies. That is something that we haven't been able to achieve. So there are these large companies who are doing relatively well, but the small companies are failing to graduate from the small balance sheets, the small operations into larger companies. And that is something that we need to figure out what the potential reason might potentially be. So all manner of regulations, etc., inspections. So all of that now needs to be decriminalization of many of their activities. So all of that instills more confidence. The ease of business that we have been talking about, that now seems to be accelerating, which is a very positive move now.
Understood. So the second type of reform you're talking about, Saugata, is, as you said, factor reforms, which is what goes into production.
Yeah.
And so what goes into production is, as you said, land, it's labor,
right, electricity,
yep. And all these other things, even, and things like, one interesting thing you mentioned is judiciary. Now, if the judiciary is very efficient,
right,
then people have more confidence.
That's right. Resolution becomes easier. Problems become easier.
And, people like, today maybe a lot of time is stuck in the judicial system. That gets released, and entrepreneurs can then focus on building the business. Similarly, all the other things like labor laws you mentioned. Again, a lot of, maybe because there are many labor laws, a lot of time has going into figuring out all of that.
Yeah.
Now that the labor code has been made into a smaller set, it is clearer, simpler, and so on.
Easier, that exit. Closing a factory, for instance. The government has been gradually, progressively increasing the threshold.
Right.
So from 50 people, where you have to, where there are other issues that you need to face with, if your labor employed force is 50.
Right.
So now that has gone up, I believe, to 300.
Right.
So you can actually shut down factories, etc. So business is the process of taking risk.
Right.
You are bound to fail in some cases.
Right.
Once you fail, you should be able to shut down the business, move on, and start something afresh.
Right.
Which is what the Chapter 11 bankruptcy code did, which the IBC tried to replicate.
Right.
To a certain extent. Now there were problems with IBC. Now they're trying to fix the problems with the modified IBC framework. So these things, you get in the ease of entry and exit from business. entry was relatively easy, exit was almost impossible in India.
Right.
And so that was one of the reasons why companies did not or could not increase the scope and scale of their businesses. Now those conditions are gradually being removed, which is a very positive side.
Understood. So this is the second set. Are there any other type of reforms?
There's that entire regulatory. People are saying, which is a polite way of saying that too many rules, compliances, etc. Criminal nature of some of the lack of compliance. So all of that deters a lot of entrepreneurial activity. I mean, nobody wants to go into that hassle, of managing the process of business rather than the business itself.
Right.
So those are the ones that need to be taken out. So the government has been doing this. Friends at the Prime Minister's Economic Advisory Council, Niti Aayog, they have been focusing on all these small, obsolete laws, regulations, etc. 3,600, 4,000 have been removed from the books. That still didn't seem to move the needle too much. And that now needs to accelerate.
Right. And so genuine kind of, for lack of a better word, deregulation, or maybe simplified regulation.
More rational regulation.
More rational regulation, more balanced regulation maybe. So that the compliances are not onerous.
Yeah.
And also the penalty of non-compliance are also not, they are also proportionate.
That's right.
Also not to say that,
you can do whatever you want, but
proportionately, like, if there is some small clerical error, then,
absolutely,
it should be dealt accordingly. If there is a criminal issue, it should be dealt accordingly.
That's right.
So broadly, that's kind of, and as you rightly said, this may be a very opportune time to do this, because in every crisis there's an opportunity. Great, very helpful to get this perspective, Saugata. Let's move to your role and the MPC and so on and so forth. So first, can you just help explain for us what is the MPC and what does it do?
So the MPC, the Monetary Policy Committee, a group of 6 wise individuals, this came into being post, you remember in 2013, it used to be called the taper tantrum.
Right.
Chairman Ben Bernanke at that time of the Federal Reserve, US Federal Reserve, announced that we are going to draw down our balance sheets, which had expanded massively post the global financial crisis. So that spooked markets. We got hit badly. Investors exited in droves, etc. So that came in. At that point in time, monetary policy used to be essentially the preserve of the Reserve Bank of India, and that to one individual, the governor of the Reserve Bank of India. He took the final call.
Right.
There used to be a entity called, a body called the Technical Advisory Committee, TAC. At that point in time, where various experts were part of TAC, but they were only advisory, as the name implied, advisory committee. So they advised, but the final decision was on the basis of one individual's call. So at that point in time, after the Fragile Five, we got past it. Governor Raghuram Rajan had come in and taken over the position of governor. So he set up an expert committee headed by Dr. Urjit Patel to review, rationalize, and strengthen the monetary policy framework at that point in time. So there were some decisions that were taken. One, so rather than one individual, a committee would take care of the essential decision by vote. So the MPC in India comprises of 6 members. So 3 are from the Reserve Bank of India, the ex officio, the position, whoever holds the position, the governor, deputy governor, and the executive director in charge of monetary policy. And there are 3 additional external members chosen by whatever process. So that's the MPC. So the other major thing that was taken before this, monetary policy used to be on the basis of what was then called the multiple indicators approach. So at some point it used to be growth. So growth was a problem. Other than that, inflation. Then there used to be money supply. So controlling the growth of money supply, bank credit. Before that, say 20 years before, there used to be a credit season. It used to be called, wasn't monetary policy. It used to be called credit policy. So lean season, busy season, etc. for credit policy. So that was felt to have become obsolete. The first inflation targeting framework started in New Zealand in 1997, long time back. So at that point in time, throughout the world, the central banks were adopting what was then called the flexible inflation targeting regime, FIT. So one was the formation of the MPC. The second one was, from this multiple indicator approach, it was decided, the committee recommended that monetary policy take on fix on one nominal anchor, as they called, one quantity. And that was felt the best nominal anchor at that point was inflation, CPI inflation, consumer price index inflation. Even before that, sometimes it used to be the wholesale price inflation, sometimes the CPI. So they decided that the nominal anchor on which monetary policy would be based would be the inflation. And then the third part that came in is what this level of inflation would likely be. So they decided, based on global practices, most of the global developed market G7 central banks have their inflation at 2%, the target inflation at 2%. They felt that since India was a faster growing economy, would need to heat up a little bit more to be able to sustain that growth, for producers to have that incentive to be able to get that profit margin. So he needed to tolerate a little higher inflation. So they decided to fix on 4%. But beyond that, earlier RBI analytical studies had suggested that 6% inflation was a threshold beyond which it became growth decretive. That inflation at 6% then began to hit growth. So that was the band that came in. So the developed market band at the lower end of the corridor, as it's called, 2%, the target at 4%, and the upper threshold at 6%. So that was the inflation band. That was the flexible part of that inflation targeting. So the target line was fixed at 4 and the upper band at 6, the lower band. So a corridor of 400 basis points. That means 4 percentage points. So this framework came in. The report was submitted. I think the committee was formed in late 2013. The report came in 2014. The MPC, the first MPC, was notified in June or July of 2016. And then the first 2016 October, there was the first MPC meeting. There have been 3 MPC. The MPC is notified for a period of for 4 years. So from 2016 onwards, the current MPC is the third MPC that is there. So that's the broad monetary policy. This is what you said, the operating framework. This is what the operating framework of the monetary policy is. So the MPC meets once every 2 months and then looks at the current conditions, at the macro financial conditions that exist at that point in time, and decide what the optimal action would be. So there are 2 steps, two decisions that the MPC usually takes. One is a mandate in the MPC that is given in the MPC. The mandate of the MPC, by the way, stepping back one bit, is to ensure price stability, which means keep inflation in that 4% plus minus 2%. At the same time, it needs to support growth. So in the world, only the Federal Reserve, amongst the major central banks, only the Federal Reserve has a dual mandate of maximum employment and price stability, inflation. All other central banks are focused solely, the European Central Bank, the Bank of England, Reserve Bank of Australia, are focused only on inflation. So India is a little bit of a via media. So between the Fed and part, so inflation is the primary target, as the secondary target is supporting growth. So if inflation is contained, then whatever needs to be done to support growth is the mandate of the MPC.
Understood. Great. Very, very interesting, Saugata. Just to kind of summarize a few things. First, where did the MPC originate from? MPC originated from post GFC,
right,
where the Fed in particular, but also many central banks globally, had a fairly loose monetary policy. They printed a lot of money, and the balance sheets of many central banks grew very significantly.
Absolutely.
Around 2013, Fed started to say that, look, we've expanded our balance sheet dramatically. We now want to, kind of contract it a little bit. And that also implicitly meant that the rates would go up and, because obviously the supply of money is going down, and hence the cost of money has to go up. And when that happened, it caused what is called the taper tantrum, where effectively from an Indian perspective, FIs basically dumped India and moved money to the US.
Right.
Because their expectation was that they will get better rate, like from 0 interest rates in the US, now they will start to get higher rates.
Yeah.
So they just dumped India and they kind of moved to the US. And in particular, it happened to India because the macro situation was not great.
Right.
Our inflation was high, indebtedness was high,
Growth had been
slowing, and so it's very different from the situation we are in right now. Let's say where actually we are quite strong as an economy. At that point, the economy was not looking great. And this inflation had been high for a period, like it was not short, it was for like
absolutely
2-3 years.
2010 onwards, the
inflation was had high inflation. And so none of the fiscal parameters were looking great.
That's right.
And so in that situation, when there was a little bit of disturbance outside, folks just dumped India and took money out. What that did was it impacted our forex, our kind of rupee stability materially.
Absolutely.
And that is a time when, all this, there were lots of things that were launched by the RBI in the short term to manage, like, attracting NRI deposits was one of the
FCNRs. Absolutely.
All of that was done at that time.
Yeah.
And also a long-term shift was done to say that let's move to a
more systematic, institutionalized mechanism for conducting monetary policy.
Right. Yeah. So that's where it got set up. The MPC is set up by an act of parliament. So it's
a statutory body.
It's a statutory policy.
Yeah.
And one interesting tidbit is that if the inflation goes beyond the range, then the governor has to explain to the parliament.
So a letter has to be sent to the Ministry of Finance. Yes, to explain why. What are the steps that are being taken to bring it down to below.
So, and what this means is that it's a critical, kind of a framework, right? It's a framework that is relevant. It is very important, and hence the country's parliament actually is kind of
is involved in
setting it up and
oversight
and in the oversight of it.
Yeah.
The MPC's agenda is number one to keep inflation in this 2% to 6%.
Ideally close to 4%.
Ideally close to 4%. Target 4%. But in this 2 to 6. And if it is in that 4% range, then do whatever is required to support growth.
Absolutely.
Is the mandate. And the MPC comprises 6 members, 3 from the central bank, the Reserve Bank, and 3 external members who are chosen by rotation. So every MPC that...
Typically, they are academics. I am probably the first one coming in from the markets,
right?
So to say, I mean, economists by profession, but essentially from the markets.
Understood.
Before that, I think mostly they have been from academia.
Understood.
Great. So one of the things I forgot to mention is that this focus on inflation is great for investors. So rather than in the multiple indicators approach, you never knew what was being targeted at what point in time.
Right.
So this now gives you a sense that if I focus on inflation, I focus on the inflation forecast, because monetary policy typically, remember, is a forward-looking, is a very forward, because it takes, once a monetary policy action is taken, it takes time for that to transmit, as they say, into the markets. So the forecasts are very important. So you have to pay a lot of attention to forecasts of inflation.
Right.
Yeah. So I mean, so this provides a sense of more of higher certainty to investors, to markets, etc. On this, so that, I mean, rather than focus on multiple things, that there is one thing that I need to focus on, while at the same time giving subsidiary attention to other factors that are other parts of the macro financial situation going on.
Right.
So
understood. Great. So Saugata, so now moving on from this, so basically the MPC meets every 2 months and they take some decisions. So A, can you explain what those decisions are? And B, what influences those decisions and how are they taken?
Sure. So the decisions are basically, there used to be 2 in every MPC meeting, a statement of the MPC. You would see that one, the MPC voted unanimously or 5-1 or whatever on the policy rate, which is the repo rate.
Right.
The repo rate is the rate at which banks either borrow, or is the basis of banks borrowing or something, which is the overnight, basically the one rate round which an operating rate is fixed.
Right.
The operating rate typically, and you would have seen that in the latest report of the working group on liquidity management, the operating rate used to be the weighted average call rate, the interbank call rate, and they've decided to keep that as part of the operating rate. So the repo rate is fixed, which is the first part of this entire range of interest rates, right? Yeah, they have different maturities of different types of paper, sovereign paper, SDLs, state bonds, state government bonds, corporate bonds, etc. Short-term rates, money market rates, certificates of deposit, CPs, certificate of papers. So all of commercial papers. So all of that gets fixed by this one rate. So the job of a central bank is to fix that one rate and manage system liquidity, money, essentially, around a very small range, around 0.5% or whatever of this basic rate that is fixed. And let that entire range of interest rates, which is popularly called the yield curve, float around on economic conditions. Doesn't always happen the way, because the G7 central bank, the global central banks, taught us something called yield curve control, where they actually fiddle around with the entire range of interest rates, etc. But that's the conventional theory of setting the central bank rate.
So I'll just stop you here because it's a little involved point, Saugata. So firstly, repo, very simplistically put, repo is the rate at which banks can borrow from RBI. Very simplistically put, right? There are it's more complicated than that, but that is the rate at which
basic point.
This is the rate at which banks borrow from RBI. This is the rate that the MPC targets.
Yeah.
The central bank, then there is something called the call market.
Yeah.
Call market is the market where banks borrow from each other.
Yeah.
So Axis Bank can borrow from SBI, SBI can borrow from whatever, right? There are some borrowers and lenders.
Yeah.
And that's an overnight meaning that it's one day borrowing.
Yeah.
The central bank will, now this borrowing lending, basically the rates are determined by liquidity in the market.
Right.
So if there is too much money, then the rates by definition will come down, because all banks will be rushed with only, there will be few borrowers and more lenders.
Yeah.
There will be few borrowers. Yeah. There will be few
borrowers and more lenders.
If the money is less, then there are more people who want to borrow. So in the latter case, the rates will go up. In the former case, the rates will go down.
Yeah.
What the central bank will do is, it will ensure there is enough liquidity, so that the interbank rate, this rate is 50 basis points approximately around the repo rate. 5 basis points from the repo rate. So if the repo rate is, let's say 5%, I mean it's not 5%, but let's say it is 5%, right? Then they will manage liquidity so that this rate is between 495 to 505%.
Yeah.
So that's how they operate. Absolutely. The belief now is that if this rate is around 5, which is the repo rate.
Yeah.
The other rates, which is as an example, the
commercial paper rates,
there's a government, the GSEC rate, the 10-year GSEC rate. The 10-year GSEC rate, actually the central bank doesn't control, like nobody controls, right? It's a market-driven rate.
It's
a rate at which the government borrows from everybody, individuals, institutions, etc.
Yeah.
But if the repo rate has increased, then by definition the GSEC rate will
also go up. Yeah,
because there is some people will say that if the rate is low, they'll say, why should I put money here? I'll put money here.
So that arbitrage thing that works, if I can borrow something cheaply and something is mispriced at something, offering too high a rate, then I can borrow from here, put in the paper, buy that paper, which immediately, when I buy, the rate increases, the interest rate on that falls, because bond interest rates and prices move in reverse.
Correct.
Yeah, so that arbitrage seeks to narrow down that gap.
Yes.
An inordinate gap that could open up between the repo and any other market rate. So that manages that arbitrage, closes that arbitrage.
Right. So there is the GSEC rate. Similarly, as you said, there is commercial paper, which is shorter term paper done by corporates or by banks
or mutual funds,
etc. Again, the central bank doesn't control those rates. It doesn't even participate in the buying and selling of these things. So completely market rate thing. But by moving the repo rate, this also moves because of various kind of similar logic, right?
Right.
And then there are at least 30-40 different rates in the market.
Absolutely. So there is the corporate bond, the AAA 10-year corporate bond, AAA 5-year corporate bond. Right. There's the mortgage rate, fixed income mortgage of 10 years or whatever. So each rate is basically priced off that repo rate.
Of the repo rate.
So one thing that I need to mention over here, that one mechanism by which the operating rate which is that rate which is 5 basis points, the weighted average call rate, the call rate. So that involves liquidity management.
Right.
So liquidity management is not part of the MPC's mandate, but that is absolutely critically tied in with monetary policy, because the operating rate around which the central bank adjusts its own version of the repo rate. So the repo rate is the signal rate for the market, around which, so liquidity management is a very key part of that. Recently, you would have seen, say from the beginning of this year, 2025, so January, you've seen an enormous amount of the shift in the liquidity position from a deficit of around 2,50,000 crores every year on every day on average before December. It suddenly shifted to about 1.5 lakh crores, then 2 lakhs, then 3 lakh crores every day, to a surplus. There comes in the next part of that monetary policy framework. Just like there is a plus minus 2% target on that inflation, for plus minus 2%, there is also a corridor, a gap between the repo rate and the maximum operating rate that the central bank will allow, and the minimum operating rate the central bank will allow. So till about June, all these short-term rates, the weighted average call rate, the 90-day T-bill rate, etc., were at that lower bound of that corridor. That is called the SDF.
Standing deposit facility.
Absolutely, standing deposit facility. And before that, these short-term rates used to be at the upper end of the band, which is the marginal standing facility, MSM. So all of that. So within the band is the maximum that the central bank will allow to move. Because other than that, I mean, it's the lender of last resort, it's the borrower of last resort. You have your money, I will pay you. This is the max that I will pay you. If I pay you 25 basis points below the bank, there is no reason why you should go to another bank, to another entity, financial entity, and get 35 basis points below that. So that's the gap which manages that liquidity. And that comes in, that ties with the second part of what an MPC does, which is the stance.
Right.
So the stance has two functions. One is this thing on, the stance is either accommodative or neutral or tight. So depending on which phase of monetary policy you are in. So if you're in a tight phase of monetary policy, which typically was till the October policy meet, October of last year, 2024, tight policy. So there, the tendency would be to arrange the operating rate in a fashion that it's closer to the upper end of that band. When you move to neutral, liquidity should be consistent with these operating rates coming in close to the repo rate. On the other hand, then when you shift to accommodative, which happened first in the December policy, then carried on into the other policies, the ideal from a central bank's perspective, not the MPC's, liquidity, the overnight rate should be closer to the lower end of that band, the SDF, the facility rate should be closer to that. So liquidity is adjusted in a manner where the overnight rate falls towards the lower end of the band. Then when it's moved to neutral, the central bank then begins to manage its liquidity in a sense that it brings those rates back up to the repo rate. Then at some point in time, not in the near future, of course, because we don't see a situation really. So if you need to move back to a tightening stance of liquidity, then the liquidity will be further sucked out of the market so that these operating rates begin to move toward the upper end. So that's one part of the liquidity side of, and because these short-term rates moving up and down will again influence the whole range of interest rates, because the cost of borrowing increases, the cost of lending, of depositing your surplus funds falls. So that influences the whole range of interest. But the stance, the second part of the MPC decision, serves a deeper purpose. It's a form of guidance. It's a form of forward guidance where, again, you begin to indicate that it's not just this policy meet decision. What is likely to happen over the next 2, 3, 4 policies? What is the path of the repo rate that is likely to evolve? So if you think that inflation is likely to be under control, if you think that growth needs a little bit more support, then you will shift to accommodative. That is to say, that gives you a guidance that the next move is likely to be down, a cut. There is also a pause. I mean, accommodative does not mean that the next one will be a cut. There's a pause, but I mean, it gives you the sense that, I mean, there are more cuts on the horizon.
Right.
And neutral, on the other hand, says that I can move either way. I can pause, and the probability of a pause increases. I can also hike if the need arises. A tight policy, on the other hand, says that I can pause, but the likelihood of a hike in the interest rate, rise in the policy repo rate, that becomes more probable. So this gives a sort of forward guidance too, and forward guidance is very important now. So I mean, the way that the central bank, forward guidance is communication with markets. How markets are guided into the treasuries, other institutions, borrowers and lenders of funds are guided onto the potential path of interest rates. It used to be the case that central bank strategy of forward guidance used to be obfuscating, ambiguity. Alan Greenspan, one of the longest serving Federal Reserve Bank governors in the US, had a very famous statement that since I became a central banker, I have learned to mumble with great incoherence. If you think if you think that you can understand me clearly, you have misunderstood what I have said. So from that angle of central bank communication is very, very important. So from that angle, we have now, central banks have moved to a strategy of clearly communicating to markets on what the central bank is thinking, what the next steps are likely to be. In fact, in the Federal Reserve got a little bit of attention in this last year, where they used a Wall Street Journal journalist to communicate what the Fed is likely to do.
Right.
So that, I think, is the change now, and that is, central banks no longer want to surprise market.
Right.
It's a forward guidance communication that this is likely to be the path. Adjust your positions, adjust your portfolios, etc., and then see where we can take it from there.
Right. So again, Shaul, this is even more complicated. So I'll put it in my perspective. If I'm going wrong, please correct me. So first is this notion of liquidity deficit or surplus. This basically, all banks are supposed to keep some money with the Reserve Bank as the CRR.
Yeah.
So the central bank mandates that if you have, again, very simplistically put, if you have 100 rupees of deposit, you have to keep 2.5 rupees with me in the, so like Axis Bank has a current account with RBI.
Yeah.
So in that, Axis Bank keeps 2.5, whatever is the CRR.
Whatever is the CRR.
That
it used to be 4 rupees you have to keep with the Reserve Bank.
Correct.
Now it's will be brought down to 3
over in the next 3 months, 3-4 months. So for simplicity, let's say it's 5. So if I have 100 rupees of deposits, 5 rupees are with the central bank.
Yeah.
If I have 5 rupees with the central bank, then I can lend out the 95 in the market. So now liquidity deficit or surplus is with respect to that 5 rupee.
Yeah.
That is the total amount of money in the banking accounts there.
Yeah.
At the end of the day, is it 5 or is it 4.5 or is it 5.5?
Right.
If it is 4.5, then liquidity is in deficit, which means that there is lesser amount of money in the system than what it should be put in the central bank.
Yeah.
So end of the day, I have to find that from somewhere. I either have to borrow it from the central bank or borrow it from some other bank and put it there.
Yeah.
If it is 5.5, it means equity in surplus. Actually, I can go out and lend more.
Yeah.
Right.
Partially. I mean, because typically banks will not keep anything more than the minimum, that is.
Yeah, exactly.
And because you're not paid.
You're not exactly
paid any interest on the deposits, the CRR deposit.
Correct.
But liquidity is, CRR is something that is not changed too often.
Yes.
Typically sticks to a 4%, 4.5% for a long time. The liquidity is managed by 2 or 3 other instruments.
Right.
So one, the central bank prints money.
Yes, of course.
This is a common notion that the government is printing money. The government doesn't print money. So that when the government borrows from the markets, it's borrowing from you, borrowing from me, or borrowing from somebody else. So the total amount of money remains the same. You have less money, the government has more money to spend. Only the central bank creates money. The money is created, one, through the purchase and sale of bonds.
Bonds, yes.
Yeah. So these are called these open market operations. Yeah. So the RBI buys bond from the markets, buys bond from you, gives you 100 rupees worth of bonds, gives you the 100 rupees.
Correct.
So that increases the system, the money supply in the system, liquidity in the system by 100 rupees.
Correct.
RBI sells a US security of 100 rupees, it borrows that security. Any amount that goes into the RBI is money out of the system.
Yes.
So this is one. The second part is coming in the foreign exchange markets. The RBI manages volatility in the currency. So, I mean, if the RBI buys dollars from the market, so it buys dollars from you, gives you rupees. That infuses liquidity. So this was what happened in 2023 when there was enormous amount of foreign capital flows coming in. So the RBI increased the size of its reserves, infused liquidity into the system. If the RBI sells you a dollar, what did I say? So RBI sells you a dollar and then it takes that liquidity out from the market. Yeah, so this is what was happening in the last, say, from September, October, or November, and December of last year when there were outflows in the system. The rupee was depreciating very fast and things, and that was creating a massive pressure. I mean, there are many problems with the rupee depreciating fast. So that's another way in which RBI also controls, inadvertently, but controls money supply in the system. The third part is what the central government does with the amount of taxes, say, that it's collected.
Yep.
So the central bank's bank account is the RBI. So if the RBI, so I mean, GST revenues come in every quarter. The advanced tax outflows come in. That's a huge amount of money, couple lakh crores, etc. That come in. That gets deposited with the RBI till the time that the government slowly begins to spend in the market. So these are basically the 3 or 4 large moves in domestic system liquidity. Part is actually advertent, intentional ways of controlling liquidity. The other parts are collateral damage with the RBI controlling some other segment and tax collections, etc. And that impacts system liquidity.
Right.
But the only institution in the country that prints money is the RBI.
Right. So absolutely. I was just going to the definition of liquidity. The definition of liquidity is as we discussed. Now the RBI has defined the repo rate.
Yeah.
It has also defined something called the marginal standing facility.
That's right.
Which is actually another facility where banks can borrow.
Absolutely.
And then it has something called a standing deposit facility, which is a facility where the banks, if they have excess money, they can go and give it to the RBI.
Yeah.
There are interest rates for both of these.
Right.
And the repo is kind of somewhere in between these two.
Right.
Now the MSF rate is the highest rate at which the bank will borrow from anybody. Because if the rate is lower, like if the interbank rate is lower than MSF, then they will not borrow to the RBI. They will borrow from the interbank. If the interbank, there is no money in interbank, and then, kind of interbank rate shoots up, then they will go and borrow from MSF. So MSF is kind of at the, rates will never go up.
Because, I mean, you can borrow as much
as you want. But it's at that rate. Similarly, standing deposit facility, if you have excess money, you will ideally kind of give it in the interbank.
Absolutely.
Because you get better rates in SDF.
Right.
If there is too much money, then everybody will go and put it in SDF because why will you give it?
Why will you give it? The RBI is prepared to buy it from you, and that's the lower amount.
Correct. So there is a repo which is somewhere in between. There is the MSF at the higher level. There is an SDF at the lower level. When the RBI says that we want to be accommodative on liquidity, they will do all these OMO and Forex and so on and so forth, so that the rate is actually between repo and the SDF.
Yeah.
When they want to be tight on liquidity, they will again do all of these operations so that the rate is between the MFS and the repo rate.
Yeah.
And this rate they are targeting is the call rate.
Is the overnight operating rate as it's called?
Yeah.
Call rate.
Yeah. And the way they control it is typically by doing GSEC
buy and sell.
Buy and sell. So as you rightly said, whenever the RBI sells GSECs, it is taking, like, let's say it sells GSECs and all
takes money out.
All mutual funds and banks and all kind of go and buy those kind of
so the bonds, and
so they pay
RBI, and that
when they pay RBI, there's money out of the system, and similarly they can infuse as well.
Yeah.
So that's how this thing is managed.
So one more, the other interesting part is this MSF and SDF, 25 basis points above, 25% below the repo rate. DAC itself is another monetary policy instrument.
Right.
What has happened is before, sometimes when there's too much, I mean, when you actually want system interest rates to go below the repo rate, the repo is something that you don't, I mean, it don't change too often.
Yes.
That signals uncertainty in the market. But what you can do is to change these SDF and MSF rates.
Right.
So sometimes when there's too much liquidity in the system and they say the SDF is 50 basis points below, 0.5 percentage points below the repo rate, what you can do is to get the lower bound SDF up, which has happened in the past.
Right.
So that width of the corridor, it can be 50 basis points, it can be 100 basis points, 50 above, 50 below, 25 above, 50 below, all of that asymmetric. That becomes yet another instrument for conducting monetary policy. But that again is not MPC.
Right.
That is RBI.
RBI. Understood. And so the second thing that the MPC does is the stance, which is basically saying for till we meet next time, if you're accommodative, then the rate will be kind of below the operative rate, will be somewhere, let's say, closer to the SDF.
Yeah.
And that is again guidance that the central bank
is prepared to
give to the
ease.
Exactly.
Keep ease monetary policy more easy than signaled by the repo rate.
Yeah. What that hence means is 2-3 things. One, for the banks, it's a signal saying that, look, it is a signal for us to go and lend more.
Right.
And, lending more will stimulate economic activity.
Absolutely.
So it creates growth.
Yeah.
It's also a signal for the markets that the central bank is, kind of accommodating.
Okay. With rates being lower than
so the rates should ideally kind of guide.
Because remember, these overnight rates are all borrowing costs.
Yes.
So whether it be borrowing from mutual funds, well, the so-called instruments like TREPs, the other repo market, called repo market, the overnight call rates, T-bill rates for the government, etc. All of these are the costs of borrowings. So these rates, these are operational rates.
Right.
So that operational rate signals that the cost of borrowing is actually lower, even lower than what you are getting with the signal from the repo rate.
Right.
That's the intended message.
Right. Understood. So MPC will take these two decisions. Now, Saugata, what goes into this? Like, how does the MPC decide? What data does it look at? What is the absolute key criteria? And
so one part is very clear. If inflation is at a level which is very close to or even above the two upper end and the lower end of that band, 4% plus minus 2%, that's almost a clear signal, unless, you think that this is a very transient phenomenon. So that's a very clear signal. If I can take you back to the October, to the December policy,
right,
December 2024. At that point in time, the last inflation print that had come in was the one for October.
Right.
Because the inflation at that point in time came in 1 month after the 12th of the month. So in November, before the policy, the October print was the last available inflation print. That print was 6.2%.
Right.
That breached the upper end of that the price in the inflation corridor. So at that point in time, even as it was fairly clear that growth was moderating, growth was slower, because of the fact that this was breaching the upper end of the mandated corridor, it had to be the case that rates had to be, the repo at that point in time, the monetary policy had to pause.
Right.
On the repo rate, couldn't change the repo rate. After that, the signal was, because the forecast at that point in time that the October rate would have been the peak. After that, it would slowly begin to come down. At that point, the next meeting in February, when the December numbers had come in by that time, so that suggested that inflation was coming down. And remember, inflation, these movements that you're seeing in the headline CPI inflation, is very predominantly caused by the vegetables group of food components. Food. And not just food, even more concentrated than food. Vegetables and fruits to a certain extent.
Right.
Pulses, the costs of pulses were not moving. The cost of edible oils had actually gone up. So it was this very, very concentrated, narrow set of components within the food basket. So that was determining the path of inflation. So if you felt that vegetables prices were coming down, the signals, and we track this on a daily basis from the Department of Consumer Affairs, Department of Cooperation, etc., Agmark, and they give out daily prices on vegetables. So that gives you a sense of where vegetables prices are moving. That forms the basis to a certain extent of forecasting vegetables prices inflation and head food prices inflation. So by the February meeting, it was very clear that food prices from that peak of October were beginning to come down, and growth was still struggling. Demand in urban demand, FMCG companies were not doing good. The results of the corporate results were not great. So at that point in time, the first bet was taken that look, it's very likely that food inflation, vegetables inflation will be coming down. So at that point in time, it was time to switch to that growth support function of the mandate of the MPC. So that was the first cut. By that time, by the next meeting in April itself, so you would have seen that there was one dissent in April. With the vote was 25, but there was one dissent for a 50. So at that time, it was becoming very clear that food inflation was coming down even faster than had been anticipated from that point in time. So that was the case, but there was still a little bit of doubt and ambiguity about the potential path of inflation. So at that point in time, the prudent thing was to cut by 25. The next meeting in June, at that point in time, food inflation, vegetables inflation had begun to touch negative territory. And it was evident that this would come in because the data that was coming in at that point in time. So that was the time that the majority of members decided that this was the time, given the problems that was, because by that time, by the April meeting, the first April 2nd, the reciprocal tariffs had come in. By the June meeting, there was more clarity on what the tariff regimes are likely to be. At that point in time, it was decided to front load the rate cut. Don't wait for the thing. Just cut it now. At that point in time, later we'll see. This was intended to speed up transmission in the process. So that was the basic thinking, the basic of the two mandates. But surrounding these two fundamental mandates, there are a lot of things that happen that needs to be factored into the overall structural framework, the monetary policy framework. One part is the external environment, because that has other problems in various. Basically the impact is on the rupee through either the current account, which is the trade deficit, trade surplus, or whatever, and the capital flows that come in. So that forms the backdrop of the two mandates, the trade-off between growth and inflation. The overall mandate, the domestic versus the external, is one factor. At that point in time, remember from last year, for almost 2 years, banks had been facing a deficit in their deposit accretion, savings deposit, retail deposit accretion. So that was a problem. You don't want to get deposits down too much, particularly in an environment where foreign savings are not sure. So foreign capital flows, you never know what that's going. So that becomes another set of issues that need to be considered. How much to cut, how deep to cut, etc. So that becomes yet another factor for consideration. Monetary policy is essentially all about balancing these trade-offs. The first trade-off is between growth and inflation, then between the domestic and the external environment. At the same time, all of this, while this is going on, the operating rate, the liquidity environment in which monetary policy is operating. Because remember, transmission is a very major part. The way monetary policy operates to stimulate growth or to restrict growth is via the credit channel. Credit channel meaning bank loans, other credit instruments, etc. So if the credit environment, if transmission is deemed to be fairly rapid, as is the case in the present circumstances, given that almost 50-60% of bank loans are now based on the so-called external benchmark, which is linked to the repo rate, so it moves pretty fast up and down. So that becomes a factor. How fast is this transmission happening? Do we need to speed up transmission? How best to speed up transmission into bank credit rates? So that's another consideration that happens. So all of these come together and decide what that optimal trade-off because you push one button, something else will blow up. So how best to manage the different objectives and the different outcomes that are likely to result once you take a call on the repo rate is something that figures in the discussion of the actual rate formation, what the actual decision on the repo rate is likely to be. Do you pause? Do you cut? Do you cut by 25? Do you cut by 50? All of these are bases that entire ecosystem, the so-called macroeconomic environment. And this has become even more pronounced in the recent few meetings, because this so-called famous the trilemma, open economic, macroeconomic trilemma, the impossible trinity of open economic macroeconomics, that you can either have a capital, free capital flow, capital account, that is to say foreign capital can flow in and out pretty much freely. Second, whether exchange rates are fixed or flexible. And the third, the ability of the central bank to control domestic interest rates. So the three can't happen together. You cannot have a fixed exchange rate, you cannot have open capital markets, open capital flows, and you cannot have the ability to control. So that essentially is the other various trade-offs that happen encapsulated in the three that I've talked about. There are multiple other small issues that happen. So that's the process, that's the discussion that happens through which a rate decision is actually taken.
Understood. So to summarize this, Saugata, basically this is not a mathematical formula. There is no one input. Obviously, the primary input is inflation and the expected trajectory of inflation.
Yeah.
Because that is the primary mandate as well. So that is obviously looked at very, very intensely. But along with that, the MPC also has to consider what's happening to growth, what's happening to the global macro. Actually, there's a lot of uncertainty. Then a decision maybe is different than if everything is stable. And so then you have more kind of. So in the case where there is more uncertainty, maybe you want to provide more support to the economy. In the case that everything is stable, then maybe you want to keep some stuff with you. Also, there is, I presume that there is the consideration of saying, look, kind of, if we do too much today, then if tomorrow something happening, do we have something in our arsenal that we can go and deploy? So you also you can't kind of just rush into.
So this is what central bankers called, and they fear this. They're afraid of this. All central bankers are afraid of this. A policy mistake.
Right.
So you saw that in the other case, in the case of the global central banks after the pandemic.
Right.
So
where they went and printed.
They printed huge amounts of money. Then the Ukraine conflict happened. Oil prices went through the roof. Other prices went, or supply chains got disrupted, etc., etc. So at that point in time, inflation really rose. Inflation in the US rose to about 9%.
Yes.
So if that, and at that time, because just coming out of the COVID environment, the Fed in particular and all the global central banks were afraid that if we tighten too soon, the economy might again get into a recession. So they waited. I mean, we think that this inflation is transitory. So it's not persistent inflation. They were finally proved wrong. At that point in time, all global central banks, all the global major central banks, Bank of the ECB, the Federal Reserve, Bank of England, Bank of Australia, every Bank of Canada, every one of them. And this kind of coordinated raise hasn't been seen for a long, long time. Right? Central banks cut together. So because the crisis hits everybody together, so they all cut in synchronously. But this kind of synchronized increase and massive increases from zero, the Fed took its rate to 4.5. In the space of a very short period of time. All central banks, the European central banks, the Bank of England, etc. So that was something that every central bank is afraid of. That we make something, we delays a decision, after which it becomes a problem to fix that original problem. So this is the same thing that, as you said, keep your powder dry, just in case something happens. You do not want to do things at such a pace that some shock, unanticipated shock comes in, where you are forced to reverse your decision. A policy mistake, as it's called. So you have to balance these things very carefully. You have to have a very good sense of the forward path of whatever it is that you are doing. Because remember, in the case of the so-called MCLR, the rates, interest rates, based on a whole bunch of a formula-driven rate, it typically used to take 2 quarters Now I believe it's much faster to the transmission, 2 quarters for that full transmission to the MCLR to play through. So you have to be pretty sure that, I mean, 2 quarters from now, whatever I'm forecasting is likely to actually happen. So that's the dilemma of a central bank, that you know that the current situation now warrants a certain type of decision. But since I'm not sure of what exactly is going to happen in the future, and nothing characterizes the current environment in this. So the analogy that you've heard often on this, all of you have heard often, is that you are in a dark room, we can't see anything, and you know that there are oil spills on the floor. So the optimal action to take at that point in time is to just stand still. Don't do anything. Don't walk. So that's the current environment in which caution becomes an important part of your, although you know that there is probably need to support growth, but on the other hand, the other decisions, the other parameters that we were talking about are so uncertain at this point in time that you have to pay heed to the fact that something completely unexpected could potentially happen at some point in time. And as you said, keep your powder dry.
Right. So the one aspect that I'll pick from here is this speed of transmission rather, which is when the central bank cuts the repo rate. Finally, for that, the thinking behind cutting the repo rate is that this will reduce interest rates in the market.
Absolutely.
And so, consumers will have more. Let's say you've taken a home loan, your EMI goes down, you have more money with you.
Right.
You can spend somewhere else.
Right.
And similarly for corporates, their rates will go down, so they can, spend more,
either spend more or borrow more,
whatever.
Yeah.
Now, for this to actually happen, the repo rate has to finally go into the EMI of the consumer or the corporate.
Right.
And the way this happens is that some loans are now linked to the repo.
Absolutely.
So banks do something called EBLR, which is the national benchmark linked rates. Most of which is actually repo.
Right.
And so at the time of giving the loan, it will say that your home loan is at, let's say, repo plus 3%,
right,
or repo plus 2%, whatever that number is.
Absolutely.
If the repo falls, your home loan rate also
falls by 275.
Or whatever the number falls.
Below the, after
if
the
repo falls 50 basis points, your interest rate will fall by 50 basis points. This now happens almost very close.
Almost there's a small reset.
Maybe it'll take it, or whatever. Banks typically do it at the end of the month or something.
Whatever.
So it may take 1 week, 2 weeks, 3 weeks, whatever. But it is very, very instant. Earlier, there used to be this MCLR, marginal cost lending rate, where there was a formula for banks to calculate their overall marginal cost and do it accordingly.
Absolutely.
Therefore, the marginal cost to change, it took time, because you change the repo today, your liabilities, you are only kind of, liabilities.
That's right. Deposits.
Deposits, yes.
Deposits, I mean, don't move that.
Deposits don't move. Yeah. Deposit rates are actually not linked to repo. Lending rates are linked to repo.
Absolutely.
Or whatever else.
Yeah.
Deposit rates are fixed.
Deposit rates.
So an FD at 7% is an FD at 7%.
Absolutely.
It doesn't matter what happens to the repo.
That's right.
Right. Now, bank has to go and cut that rate.
Right.
And secondly, the new FDs in that rate have to come in and change the overall cost.
Absolutely.
And so MCR took a lot of time to.
That's right.
But now it is transmission is very kind of very quick,
faster than what it used to be.
Earlier.
And a large part of that is the liquidity part, the liquidity angle.
Right.
Because if you put in a significant amount of surplus liquidity in the market, it's easier to borrow again. So the overnight rate, the short term notice money market rate, notice market rate, so all of that gets down to towards the SDF rate. That pulls down that entire the set of interest rates across the curve. So that liquidity helps to transmit a little bit. But again, as you said, deposits almost 60% are fixed deposits, 60% of the total liabilities deposit space is term deposits. But even in the term deposits, there is retail term deposits, there are the institutional term deposits, the wholesale bulk term deposits. Wholesale bulk term deposits move very quick.
Very fast, yes.
So the retail term deposits, the savings banks rates, etc., don't move that fast.
Right.
So this creates yet another problem for banks, because the intended measure to reduce the cost of funds for banks, the cost of whatever, the blended cost of funds through various instruments, that impedes that transmission into the deposit rate.
Yeah.
Which essentially then becomes a problem for MCLR.
Yeah. No, absolutely. So banks actually, as an example, right now, with reducing interest rate environment,
Absolutely.
the margins of banks get compressed.
Yeah.
Because the transmission on the lending side is very quick.
Absolutely.
For deposits to catch up takes maybe 6-9 months for it to catch up. So when the central bank cuts rates,
Yeah.
the margins of banks actually first goes down,
Right.
and then begins then the end of recovers.
Recover.
Once the FDs, when the deposits kind of reprice. Actually, when the converse happens, the margins go up and then kind of come down. So
When rates are tightened, the margins begin to go up.
And yeah, exactly.
So quite apart from the actual deposit stickiness of deposit rates, costs of deposits, there's also a problem that if deposit rates are brought down rapidly, there's a tendency, particularly for households, for the retail depositors, to try to look for to offset the lower returns on their funds, on the deposits, to try to look for other non-bank ways, instruments to try to bump up the returns, which is where until some time at least the equities markets provided one such instrument. That also comes back ultimately into banks in a completely different form. That's institutional deposits, bulk deposits, etc., which come into bank, but which doesn't lower the return, because the costs of those funds are higher than what banks would have got through the savings bank deposit or maybe even a retail term deposit or something. So those costs are higher.
Right.
So that again impedes the transmission into the liabilities, the deposits franchise for banks.
Saugata, one last question on this before we move on. Our CPI print seems to be influenced significantly by very selective vegetable prices, particularly onion. So what's the story here? How come onion determines so much, in the economy?
Yeah. So I mean, to joke about this before I actually get into the core problem of what these situations are. So there are three types of ions. A positively charged ion is called a cation. A negatively charged ion is called an anion, and a humongously expensive charged ion is onions. So that's but the basic problem remains that we lack processing facilities. India is probably one of the few markets in the world where fresh produce actually costs lower than processed tins, cans. Everywhere across the world, fresh produce is more expensive than canned produce. We need extensive at the farm gate processing facilities. So at some point in time, there's a huge glut of onions. These need to be processed, dried, powdered onions, etc., which can be reprocessed, refurbished in cooking, etc. This is particularly true of tomatoes. You hear stories about tomatoes being dumped at the side of the road. There's too much production of tomatoes, which is probably exactly what is happening in the current vegetable spices. So, I mean, there's an excess production of vegetables of these. So, if in a proper, if the processing facilities were in place and close to farmers at the farm gate, because it's difficult to transport these, becomes expensive. So that would, I think, serve a large part in smoothening the flows across the various cycles. Because typically, I mean, these things, one of course is the weather. So I mean, if you have a rainfall shortage, etc., that increases prices. But the same thing happens if you have excess rainfall, that also creates problems. But other than that, farm produce typically works on what is called the cobweb. So the cobweb meaning you produce more in a year, prices crash, and then the next year there is no incentive to produce, and there's a supply shortfall and prices rise. So this increases volatility, and very unfortunately, the latest CPI base data starts from 2014-15. If you plot the vegetables or food price inflation, volatility actually seems to have increased in the last 4 or 5 years, where you would have thought that all the reforms, etc., the contract farming would have brought down prices. Vegetable prices seems to have become more volatile. This is the cause for concern. I think this is the key part that India now lacks, that we need more and more processing facilities for smoothing the flows of prices across vegetables.
Great. So, Saugata, moving on to the third part of this conversation, which is there is obviously a short-term impact of all of this, but also there is a a little, I would say, medium term, what's happening to savings and what's happening to resource allocation, as an example. One thing we can see in the data very sharply is that savings in the household sectors have fallen and they moved to the corporate sector. So corporate savings have gone up, household savings have come down. And something obviously in the macroeconomic situation is kind of causing this kind of a shift. So in your mind, A, what's happening, and B, like what's the way forward? How does this look going forward?
Two things. One, on the overall saving situation, I think it's a little bit, there is some concern about this. Because our access to foreign savings in particular, the savings that came in from China, with China growing at 9%, 8%, 7% year after year, and a large part of their incomes being saved. China has household savings rate of over exceeding 50%, 55%. That overall China growth has slowed down, and people are beginning to consume more because that's the focus of growth, shifting from the export markets, investment-led growth into consumption. So that access to the Chinese savings has come down. From the global financial crisis onwards, central banks had infused, that we were talking about before, had infused enormous amounts of liquidity in the system, the so-called quantitative easing. That has now shifted during the tightening phase of policy. Again, I don't know, it will take some time because now the easing cycle has started. So from the COVID, post-COVID situation, so the quantitative easing had shifted to quantitative tightening. In other words, that money was being taken back from the system. So that $18-22 trillion that had been infused during the COVID situation from the GFC into the post the COVID, that is now beginning to tighten so that access to those funds are also tightened. So overall, the set of foreign savings that we had access to, that is likely to have shortened, squeezed significantly. That takes us into domestic savings. So domestic savings, one, of course, because corporates have been completely deleveraged, the balance sheet strong, enormous amounts of cash coming in through the tax cuts, through the liquidity that RBI had infused in the system. So flush with liquidity, so corporates had access to more savings, and that, of course, because the corporate savings, buybacks, etc. So that some part of that was taken in from the household sector. Even in the household sector, within the savings, one was, because of the leverage, that household leverage had increased significantly since the COVID era. One part of that was because banks, NBFCs, other financial institutions, because corporates with this kind of cash didn't want to borrow funds. No demand for credit. So banks had to increase the retail exposure on the credit portfolio. That resulted in a significant increase in household leverage. So once you're leveraged, you have to pay EMIs on the leverage, etc. So the amount of savings that households had at that point in time typically got drained out, because that a large part of that, of course, it led to a significant increase in household consumer demand, consumers purchases, etc. Household goods, white goods, automobiles, housing, etc. But the EMIs that came in increased. So a curious feature that you saw in household savings, there was an increase in physical savings. A house is considered as a physical savings, physical asset. Machinery for MSMEs is a physical asset. So that would increase significantly, but the financial savings of households that got squeezed. At that point, so while this was happening, that leverage was increasing, household leverage, particularly in the urban areas. First, in the rural areas, rural savings were not all that particular, so that didn't affect the household saving. But then, with various problems in the urban areas, urban salaries were stagnating, and in corporate salaries, etc. So that also began to reduce the disposable income of households. Consumption was still relatively stable. It didn't come down so much. So what was happening was the household consumers were essentially, probably, likely beginning to eat into their savings to maintain a certain lifestyle, to maintain their consumption. But once income growth came down, even that increases. That's one of the reasons why aggregate demand in the urban areas began to come down. So all of these things began to work together. So lower income growth, lower salary growth, high leverage, having to pay out higher interest, EMIs, etc. squeeze from household savings into the corporate savings, as you mentioned. So all of these came together at one point in time, which actually showed up in when stressed assets, stressed household assets, retail assets on the banking and NBFC sector books, which also caused the credit to households to begin to come down. So that, I think, essentially all of these 3 or 4 factors playing together began to squeeze household savings in the system, which on a longer term perspective is not a good thing. I mean, because that reduces access to savings. And banks having to borrow rely more on corporate savings for their liabilities base, for the deposit base. That actually increases the cost, because and this also makes, unfortunately, liabilities for banks more volatile, because the corporate savings, wholesale bulk deposits, etc., are much more volatile than retail deposits. And actually this is bad for another aspect that banks have to manage, which is the LCR. So the liquidity coverage ratio. So all of that increases the reduces the LCR component of the banks, and still banks have to pay even higher to maintain to produce a degree of stability in the bulk deposit rates. So the overall mix from the households, a reduction of household savings, a increase in more volatile deposits from banks, that is, I think, overall creating a long-term situation, particularly in an environment where access to foreign savings is likely to come down over a period of time.
Understood. So basically, in just summarizing, what has happened is corporates are not investing, perhaps because they don't, whatever, right? For whatever reasons, corporate investment hasn't picked up in the country.
Yeah.
At the same time, they have deleveraged. So they have used all the cash that they generated
Absolutely.
to pay off the debt. And so now debt is at a very low level.
Very low level.
So now they don't have interest payouts as well.
Absolutely.
And so now whatever cash is coming in is going into corporate savings.
Yeah.
Plus there has been the corporate tax cut.
Absolutely.
Has helped as well.
Yeah.
And so essentially what has happened is that the same, like ideally what would have happened is, when this happens, corporates say, okay, now why don't I expand capacity?
Yeah.
So that I can produce more, and they will go and invest.
Right.
The moment they invest, the savings move from the corporate sector to the household sector. Absolutely. Because they have to pay salaries, and they have to whatever, they have to buy stuff to build the factory, and all of that finally goes to the households.
Yeah.
This part of the cycle has kind of got a lot cut. It's stalled.
Yeah.
Or it's got postponed.
Or postponed.
Hopefully it is postponed and not start. So that has got postponed. So savings are not moving to the households.
Yeah.
But households continue to buy and procure and so on and so forth. So the outgo is continuing.
So of the total incomes, more is being spent.
More is being spent on, and not enough is coming back.
Coming into savings.
So this has resulted in the savings kind of shift.
Yeah.
For this to move back, I guess the investment cycle has to start, so that the kind of this thing comes, or maybe there has to be some policy.
So that's the problem. This essentially becomes a chicken and egg problem.
Right.
So since consumers are not spending significantly more, there is excess capacity in the corporate sector, in factories and other available establishments. So corporates don't have to increase, because they don't see a path to higher consumption, higher demand, etc. They are not investing in capacity, and as you said, that feeds back into the household sector. And because remember, a large part of this savings doesn't go directly into household, but to the very small, micro and small enterprises, which are the part of the supply chain for these, for the big corporates. And it is unfortunately the same micro and small businesses which is the consuming class.
Right.
So that becomes a vicious cycle. So that needs to be broken at some point.
Right.
The government has started, which is the tax cuts initially for the corporate sector, which didn't seem to produce the desired results. Now they're shifting via tax cuts, direct tax cuts, GST rationalization into the household sector now, to be able to see whether this stimulates demand in the household, which leads to further investments and gets that virtuous cycle back into action.
Understood. Great. Saugata, we covered a very large range of topics. So thanks for sharing your perspectives. Big part of our conversation was around the MPC, which was set up post the GFC and the 2013 taper tantrum, the MPC's primary objectives are two. One is to set the repo rate and second is to set the liquidity stance, with the objective of A, maintaining inflation in that 4% target but plus minus 2% as a range. And second, if the inflation is managed, then to support growth in the economy. So we spoke about the composition and so on and so forth. It's a six-member committee, 3 from the RBI, 3 external. We also talked about how the decision making is done, which is quite complicated. It is not straightforward. Also, it is complicated by the fact that large number of variables are there. Obviously, there is a CPI print, but you would also look at macro and what's happening everywhere and so on and so forth. But B also, the MPC actions of the MPC have impact maybe 2 quarters down the line, as you said. And so whatever, and you can't change policy rates daily. You have to change it. You'll have a gradual kind of stance, and hence you have to have a clear view of what is likely to happen like a significantly down the road. So it's kind of complicated by that, and hence it obviously requires experts and people who can take these long-term calls. We spoke about how the MPC rates get transmitted through the repo, the MSF, the SDF, and subsequently how banks lend, and how various rates are set, etc. Which again is it is very complicated, but also extremely interesting topic for just to kind of understand how all of this happens. So we spoke about that. We spoke about what impacts inflation and particularly the need for processing facilities, because a lot of the fresh produce is very volatile in terms of production quantities. And so if you're not able to take it and store it, it typically goes waste and creates lots of volatility in prices, which has increased, as you mentioned, over the last 4-5 years. Earlier in the conversation, you shared your view of where the economy is, which is structurally, India continues to be in a great place. We have great, if you look at all our balance sheet metrics and all, we are doing quite well. We have inherently the strength of a young demography and a growing country. And so there are all the good reasons for us to do well from a long-term perspective. There are short-term challenges though, some of it coming from the global, environment, geopolitical environment. Some of it is internal as well. But as you said, the economy seems resilient. The high-frequency indicators show that there is slowdown, but looks like it's resilient, and so hopefully we should pick up. And at the end, we spoke about how the savings environment looks like, and how over the last few years savings have moved from the household sector to the corporate sector, and that needs to and it has happened because corporate sector is not investing so much, and we need to find a way to break that logjam for corporates to invest. When that happens, then savings automatically move to households. When savings move to households, they also consume more, and so it's a virtuous cycle then. So we covered all of these topics. It was a fascinating conversation. Saugata, thanks a lot for joining us. It's an incredible privilege to have you.
Thank you, Samir. I mean, you have summed up in 3 minutes more brilliantly than what I did over the course of the hour. Only you can do that. Thank you so much for having me as your guest.
Thanks a lot. That brings us to the end of a very interesting conversation with Saugata. Do let us know your views in the comment section, and we look forward to having you back for our next episode.